Hello and thank you for joining Ascending Abundance YouTube channel, where I cover various strategies on how to make money with money. We can always spend less and get rich by investing consistently, but at the same time, if we can find a way to make a lot of money quicker and spend more not less and make more not less, that would be my preference. And this channel is dedicated to exploring various strategies of making money: real estate, crypto, stock market, business, anything that goes. This particular episode is about Canadian banks, and in the news I've seen that TD Bank is the most shorted bank, and I see some panic out there with some of my friends raising short bets against TD, etc., etc. So I wanted to explore not TD, I would explore Royal Bank to see if that bank is safe, if Canadian banks are a staple of our economy and they could be trusted as an investment opportunity. So what I'm looking for is the Royal Bank RBC, Investor Relations, simple Google search, comes up with a couple of items up here. I go to financial information and clicking on the report to shareholders. That's the biggest report out of all of them. It will include all of the financial information, all kinds of notes, all kinds of graphs. I do not typically go for quarterly slides because that's more of a marketing material to be presented to investors. And within the pop-up, it's typically a PDF file, just search for financial statements. It could be on page 47 in this case, it could be up front, it could be at the back. You will find them, there's no escape kind of thing. Financial statements are always there. And what I, as a chartered financial analyst and a seasoned investor, will look for is increase in assets, and specifically increase in loans. I want the loans to be going up, not down. Even though this is a 3 months and it's kind of year over year, not year, quarter over quarter comparison, it still kind of tells the story. We can go year over year, we can trace it over the 5 years, we can do quarterly. I mean, you can go as deep as you'd like. This is just a short, quick check on this, what's going on with the bank. In Q1 of 2023, as you see, they haven't done anything else this year yet. And the new report Q2 is coming at the end of April, so I'm going to be watching that closely. So overall loans have grown, retail loans are kind of slightly so, a little bit more on wholesale, but overall healthy, it's not going down, the loans are not getting repaid, the business is still flowing to Royal Bank. That's all I want to know. In terms of liabilities, they keep increasing the personal deposits, they are a little bit less in business and government, but personal is probably a good indicator here. Business and government is a little more volatile. And that's really all I wanted to see. I don't quite like that their retained earnings are almost unchanged, but they're still up, and that's all that matters. The bank is not in a hardship, they still have their retained earnings, that's fine. And as you can tell, the bank is not your typical company. They have very little equity compared to the size of their liabilities, but if you were to take debt to equity ratios, just like you would do with a manufacturing company or Apple or something like that, that would be wrong, because the bank is in the business of making money from money. They have a ton of assets and a ton of liabilities, and only the small difference in the fractional reserve, that is their equity. So don't pay attention to that to equity for banks. They're a special beast. Now that we know the assets are fine, how are they doing in terms of income? And with the interest rates on the rise, it's no surprise that their interest income is jumping really high. Their interest expenses is also up, but the difference between interest income and interest expense is nicely so up quarter over quarter, and that's what, well, actually year over year, and that's what I'd like to see. In fact, I was expecting this number to be even bigger, so let's see how that behaves next quarter. Non-interest income is also up, and also kind of nicely so, on a whole bunch of other smaller items. For example, this one is investment management and custodian fees. Alright, so they've charged a little bit extra fees, maybe some service charges went up here and there, and overall the bank is making more money. So total revenue is definitely up, good thing to see, not a huge concern over there. What I'd love to see though is their provision for credit losses, or allowance for credit losses, and this is their cash flow. So that's the piece that was here somewhere in the income. It was saying note 4 and note 5. Notes to financial statements are always below the financial statements, so just keep on scrolling. You kind of find a whole bunch of information. See, this is note 3, keep scrolling down. There you go, note 4. So I just want to see the kind of the credit losses, but not this way. I want to see retails. I want to see residential mortgages. There you go. It's note 5, loans and allowance for credit losses. So how is that behaving year over year? At the beginning of the period, then provisions, then kind of write-offs, etc. And then we could see that it's not that much different. Last year, at the end of January, they had I'm guessing it's billions, millions of Canadian dollars. So this is billions of dollars, and now they have $4 billion. So not huge. Write-offs, yeah, they went up a little bit, but compared to the net income of the bank, this is nothing. This is not even worth kind of the trouble. And the provisions have gone up. They've increased the size of their provisions for credit losses, which is great. They're just being safe. I don't think this is enough. I think it's going to continue going up. And the higher the provisions, the more the bank is setting aside funds towards potential defaults. And I welcome that, because that goes against their income. It reduces their income, but it sets aside a provision which they can use then in the future. And if those losses don't materialize, those provisions go back into the allowances, will go back into the income, and we might see a bump in income if things don't go too bad and these provisions are not needed. Again, those are not actual losses, these are just provisions against potential losses. And what's also interesting is to look at the stages. This is the best story. This is what I've learned when I was in credit cards risk management. Stage 1 is kind of these people who don't pay on time, right? Like they're just kind of delayed. Stage 2 is already 60 days past due. That's concerning. You want to chase after them. There's a chance that they will default. Stage 3, it's an impaired loan. It's 90 days past due. Very likely not going to get repaid. You're probably getting just pennies on that dollar. Or if it's a secured loan like mortgages, then you might have to chase after those assets and actually recover your loans. But as you can see, compared to last year, residential mortgages, total, no big deal, right? They're a little bit of a bump, minor numbers, nothing concerning. Stage 1 is higher, but again, I mean, compared to the size of the bank and the size of the loans, like in like trillions, I don't even know, probably not trillions in residential, but a ton. Personal loans, yeah, also an increase, but not huge. Stage 2 is increased, right? Stage 3 is increased. Every stage is kind of higher, other than stage 1, which actually is surprising. So people who went overdue, they recently are not going overdue as much as they had in the last 60 to 90 days. So that's a good sign compared to last year. So maybe the credit conditions are actually improving in personal loans. In credit cards, that's what we see, another bump. So the losses are going up. There's no escape from that, but they're marginal, like compared to the size of the balance sheet. And if you take total, it's actually down. It's actually a lower amount compared to 2022. So am I concerned? No. Going back again to the balance sheet of the bank, look at these assets. Retail loans, 549 billion. So if something goes up by 100 or 200 here, or even a billion, which we haven't seen, that would not make a huge dent in their profits. Look at the profits of the bank. They're in 15 billion in a given quarter. So 1 billion here, 1 billion there, it would suck, it will be bad, it will go straight to the net income. But at the same time, usually when provisions for credit losses go up, that's when the interest income is also going up significantly. So hopefully the kind of the mix of increased interest and dividend income and net interest income for that will more than compensate for the increase in provision for credit losses. And if that happens, as you can see here, for example, right, like we got $1 billion higher net interest income, but only 400 million, what is it? Yeah, 400 million increase in PCL. PCL is short for provision for credit losses. So I'm mumbling a little bit. All in all, I think this is stable, this is very sound and safe. We could take a look at Q2 when it comes up, but I don't see huge issues with Royal Bank. I don't see their losses spiking. Maybe this will change, maybe they will show a little bit, but as you saw in the stage 1, stage 2, stage 3, there are ways to monitor the flow and actually see if the balances are coming up a lot at the front. And that means in the next quarter you see a lot of them going, you know, to face stage 2, stage 3, and then there's a write-off, and then you'll see even higher PCLs. That's not quite happening, so I believe the Canadian banking stocks are still a staple, kind of the orphans and widows stock. What is that expression? And I continue holding it, I continue trading sometimes, Royal Bank for example, and wish you all the success. And the dividend yield on Royal Bank is still above 4%, and the rule of thumb is anything about 4% yield on the Canadian banks is a buy. Anything below 4% is kind of anybody's game, but above 4%, even when the overall interest environment is high, is still a good dividend to get, and that dividend is growing. Royal Bank, I believe, bumped it by 7% last year. So if we keep on increasing dividend 7, 10, 12, who knows, percentages per year, then you're not only keeping up with inflation, you're beating that inflation. Thank you very much for watching. Let me know what you think. Are you concerned with Canadian banks? And is there anything else in this topic that you'd like me to cover? Otherwise, see you at the next video. Thank you.